it's important to remember that over the last 11 years, we've built 5 mines in West Africa. All of them have been built in less than 2 years, on budget and on schedule. And in fact, our most recent construction project, the Lafigué mine in the Ivory Coast, was brought from discovery to production in about 7.5 years. So this isn't anything we haven't done before.
Hello, you're watching Proactive. Joining me is Endeavour Mining Vice President of Investor Relations, Jack Garman. Jack, very good to speak with you. You had a great first quarter helped by the buoyant gold price with free cash flow hitting a record. How sustainable is that level, especially if gold prices stabilize or soften?
Hi, Stephen. Thank you for having me. You're right. It was a great quarter. I think we started the year with lots of momentum that was really generated late in 2024. And as a result, in Q1, we delivered a really strong quarter of production where we actually delivered about 30% of our full year's guidance in the quarter alone. And importantly, our all-in sustaining costs came in below the lower end of the guidance range. So following that Q1, we're really well positioned to achieve our full year guidance. Now, obviously, the strong operational performance was coupled with increasing gold prices, which helped us deliver record free cash flow for the quarter of about $409 million, which is equivalent to about $1,200 per ounce of free cash flow generated, which is really staggering. Looking forwards really to the rest of the year and into next year, our focus is really on maximizing free cash flow generation. We obviously have fairly low total capital budget for this year and for next year, as we've now finished our growth phase late last year. So we expect to maintain reasonably strong free cash flows going forwards until late 2026 when we start our next growth phase. Our view fundamentally is the best way to maximize free cash flow generation is by keeping our costs down as we progressively grow our production profile over the next 5 years.
Jack, you reduced net debt by over $350 million. How much further deleveraging is planned before more aggressive buybacks or dividends are considered?
Good question. And following the completion of our growth phase in Q2 last year, we really prioritized deleveraging our balance sheet. We've been able to do it probably a little bit quicker than we expected, thanks to the high gold price, as well as our strong operational performance. Now, as you mentioned, in Q1, we reduced our net debt by about $354 million. And importantly, thanks to the strong EBITDA growth and the strong free cash flow generation, our leverage has also materially improved down to 0.22 times net debt to adjusted EBITDA, which is significantly below our 0.5 times target. So at this level, we're comfortable that our balance sheet is both resilient and well positioned to support our future growth, as well as our increasing commitment to shareholder returns. And on shareholder returns, as you mentioned, we've clearly been increasing our commitment. In Q1 alone, we delivered about $40 million worth of share buybacks, which is about 4 times higher than the rate we achieved in Q4 last year, in addition to our increased minimum dividend of $225 million this year. So for the full year, we're expecting to significantly increase shareholder returns over last year. I think important just to flag over the last 4 years, we've returned about $1.2 billion to shareholders through our shareholder returns program, which is equivalent to about a third of our market cap over that period. And looking forwards with strong gold prices, strong free cash flows, we expect to continue improving on that return.
With your full year performance weighted to the first half, are there any operational risks or seasonal factors investors should watch out for in the second half?
Yeah, that's a very good question. Historically, Endeavour's operating performance has been quite heavily weighted towards the back end of the year. That's partly a function of our mine plans, partly a function of the wet season in West Africa, which is typically a Q2, Q3 event. Now, this year, we've made a strategic decision to accelerate some higher grade ore into Q1, allowing us to de-risk the production profile for the rest of the year and really shift operating performance towards a H1 weighting. So, as I already mentioned, given the strong Q1, we've already delivered about 30% of our guidance for the full year in the first quarter. So based on that, we're firmly on track to achieve our full year targets.
Stifel noted that you reduced costs despite slightly lower production for the quarter. What specific optimization strategies contributed to that, and can they be scaled further?
I think firstly it's worth highlighting that in recent years, we've always been and we will continue to be one of the lowest cost producers in the sector, and that really comes down to the high quality of our portfolio, which comprises of high grade, long life assets, the majority of which are conventional open pit mines. We've got one underground mine, which is slightly higher cost, but we also benefit from the operating environment in West Africa, which is not just highly prospective, but it's also home to a lot of readily available skilled labor. There's a common currency that's pegged on a fixed parity basis to the euro. Fuel pricing is regulated and stabilized in country by government. And as a result, we have a quite stable and transparent underlying cost base, which gives us good visibility to being able to maintain these low costs over the medium term. In terms of Q1, really, we're continually focusing on optimizing the performance of the portfolio and improving productivity, having completed this growth phase late last year. So we were able to improve our all-in sustaining costs, largely thanks to some improvements in our mining costs as we look to optimizing blasting and haulage. And that's really despite increases in sustaining capital and increases in royalty costs, which are associated with the higher gold prices.
Jack, can you give us an update on the Assafou project timeline and how it's expected to impact your medium-term production profile?
Yeah, sure. Assafou truly is a tier one project, and I think that the best or the most exciting part of it is it's still growing. So we discovered Assafou back in 2022. Less than 3 years later, we were able to define a 4.5 million ounce resource for less than $11 per ounce discovery cost. Then late last year, so December last year, we finalized a preliminary feasibility study, which defined a project capable of producing about 330,000 ounces a year of production at all-in sustaining costs below $900 per ounce for the first 10 years. Now, in terms of the project's economics, at a really conservative $2,500 per ounce gold price, the after-tax NPV5 for the project is over $2.5 billion with an IRR above 40%. So at spot gold, we see a lot more value to be realized there. And as I say, we're still drilling quite aggressively at the Assafou property. So since we defined the reserve and resource that supports that preliminary feasibility study, we've drilled a further 90,000 meters. And we will drill an additional 100,000 meters this year before we provide a resource update in the second half of the year, incorporating some of the satellite targets where we've made discoveries. In terms of next steps, we're going to provide that resource update in H2. Then we expect to complete the DFS between late this year and early next year. And we could be ready for construction as early as the second half of 2026, with first production in the second half of 2028. Now, this timeline may sound optimistic, but I think it's important to remember that over the last 11 years, we've built 5 mines in West Africa. All of them have been built in less than 2 years, on budget and on schedule. And in fact, our most recent construction project, the Lafigué mine in the Ivory Coast, was brought from discovery to production in about 7.5 years. So this isn't anything we haven't done before.
Jack, given current margins and market sentiment, how are you thinking about M&A versus organic growth in the near term?
Yeah, that's a very good question. And, I think Endeavour is in quite a unique position where we have this really attractive pipeline of organic growth opportunities, including Assafou, that we just mentioned. With these organic opportunities, we have quite good visibility towards growing our production by about 35% to over 1.5 million ounces by the end of the decade, importantly, while maintaining our costs stable. Now, because of this outlook, we're not in a position where we need to buy assets to support growth or buy assets to support our cost position. So really, organic growth is our priority, and we will continue to advance our pipeline. Now, obviously, as prudent sort of custodians or allocators of capital, it's important to continue scanning the space for opportunities that could be a good strategic fit, and that could be potentially value accretive to the business. Unfortunately, any of these opportunities have to compete for capital with projects like Assafou, which is obviously really hard to do.
Jack, I hope you'll keep us updated on any progress with all that. Thank you very much for speaking with us today.
Thanks very much, Stephen.
Jack Garman is Vice President of Investor Relations at Endeavour Mining.